Welcome, everybody, to our panel discussion on the One Big Beautiful Bill Act, or for simplicity's sake, we're going to refer to it here on out as OB3. That's less of a tongue twister than the other phrase. We're excited to share with you our thoughts on, or first share with you what did change as a result of OB3, what didn't change, and planning opportunities related to that. I will start off with introducing myself. My name is Brigitte Sutherland. I'm a tax shareholder at Perkins Co. and also lead the tax practice group. And I'll be moderating the discussion today, but I'll allow my colleagues to introduce themselves and what they're going to be covering.
Thanks, Brigitte. My name is Sean Wallace. I'm also a shareholder in the tax department. Today I'm going to be talking about 174.
Oh,
which is that?
We promise not to use
174?
code sections. So research and experimentation, the changes, briefly recapping what happened with the Tax Cuts and Jobs Act and what's new now. And then I'm also going to talk a little bit about QSBS. Qualified small business stock.
Katie was just waiting to correct you.
Katie's policing us today.
Yeah. I'm Katie Powell. I'm the police today. I'm a tax shareholder at Perkins. Coming up on my 20th anniversary next month. By way of two mergers. I work predominantly with pass-through entities and their owners across a wide spectrum of businesses, with some concentration in construction and real estate and professional services. So I'll be covering some general tax provisions today, qualified business income deduction, expensing of assets purchased during the year, that kind of thing.
My name is Jordan Patterson. I'm a tax shareholder at Perkins as well. I work with our legacy planning group, so our high net worth individuals, estate and trust planning, so I'll be talking about those topics today.
I'm Trent Baeckl. I'm one of the leaders of our real estate practice, so I will be touching on what's been impacted for the real estate community and kind of broadly there. I also have a problem with citing code sections, so Katie's gonna be her head's gonna be on a swivel between me and Sean today.
They place me strategically in the middle for that
purpose. That is why you picked the middle seat, isn't it? Yeah. So
I'm keeping an eye on you guys.
Great, thank you. So first, we have a panel, we have a live audience here, but we do also have about 85 people that are watching the live stream. And the purpose of today's discussion is for it to be free-flowing. And, so you'll see that we're all going to converse with one another, and we also want to hear your questions in real time. So if you do have a question, if you're in the live audience, raise your hand. Somebody will come towards you with a microphone. But if you want to shout it out to us, we'll just repeat it because the people that are watching us via the live stream won't be able to hear you. For those of us that are watching on the live stream, you can text questions to that number there, and we do have people monitoring that, and they will get us your questions. So let's dive into OB3. When we started off the year, we knew that some tax legislation was going to need to happen because the Tax Cuts and Jobs Act, many of those provisions were set to expire at the end of this year. The question was, when is this going to happen? Typically based on past experience, Congress has a hard time making these decisions, and we were dreading that this wouldn't happen until, say, Q4 of this year, or worst case scenario, January of 2026, which they've done to us before. So when we heard that the president wanted to have something on his desk by July 4th, I think we were all a bit skeptical. Yeah,
definitely.
Very skeptical. But you know what? They pulled it together. And no matter what you may think about certain provisions of the bill, we're just grateful that at least something was passed by mid-year and we know how to move forward.
Christmas in July.
Christmas in July, definitely. Better than trying to understand this at Christmas.
Exactly.
Yeah, the Tax Cuts and Jobs Act was passed the week before Christmas.
Oh, yeah, that's right.
So
yeah.
that was Christmas.
That was not a good Christmas present for us. or our clients, because it makes it really difficult for us to do any proactive planning. So we did get that Christmas present in July. So let's first start off with this bill. What didn't change as a result? What stayed the same? Jordan, you want to kick it off on the individual side?
Yeah, absolutely. And so I think kind of doing the history lesson, we were in this Tax Cut Jobs Act era. So
Can we agree that that's TCJA?
TCJA or TICJA.
We said it enough. Can we?
Katie, what do you
Katie,
think?
yeah,
The
Katie, yeah, why am I looking at Brigitte, Katie?
2017 Tax Act, right?
Okay.
Let's go with that. But TCJA, okay, we all know what we're talking about. The before times.
The before times.
The good old days. Okay. And so the idea here was if nothing passed, it was going to be doom and gloom, right? We were going to get to the end of 25, come 26, all these things were going to change. Our qualified business income deduction was going to go away. Individual tax rates were going to go up. That estate tax exemption was going to get cut in half. All these things were going to change. The SALT cap was going to go away. But
I'm sorry, what's a SALT cap?
yeah, okay.
Busted.
So the state and local tax, so our lovely itemized deduction for our income taxes and property taxes. Prior it was $10,000, it was the limit. Now we're up to $40,000 for some taxpayers, but if nothing had happened, that threshold, that limit would have gone away. So, but now, today, passage of OB3 has really continued, I think, a lot of the things for the individuals. So those tax rates have stayed the same. Our estate tax exemption has actually gone up, but it's still high. And the qualified business income deduction is permanent now.
And I think from discussions that I've had with various estate attorneys, I think everybody was surprised maybe that the estate tax exemption, lifetime gifting, actually stayed the same?
I think some people were maybe surprised, or some of us probably thought it was going to stay the same or relatively the same for a long time. I think if you looked at the whole budget and where the estate tax fits into that budget, it's a very, very small number. And it also applies to a very small subset of individuals. So not a lot of people to push back or complain about it. But yeah, now it's up to 15 million beginning in 26. It's indexed for inflation. So there's a lot of planning opportunities there.
Yeah,
And permanent, too, yeah?
Yes, permanent.
What does permanent mean?
I was about to say, so what does permanent mean with respect to tax law?
Good question, Brigitte. Permanent means until another tax law is passed, basically. So there,
Just no sunsetting.
for now, which actually gives us some clarity to work with. I mean, when you have sunsets in the future that are looming, there's a lot of planning that takes place thinking, well, if it happens, then we need to do this. And if it doesn't happen, then we've wasted all this time and money doing planning for a sunset that never reaches here. But calling these things permanent prevents that to a certain extent. So it'd be a change of administration, a change of Congress, priorities, but for now, permanent.
That's essentially where we were for almost the entire Obama administration, because there was there was a tax bill that was passed in 2001 that sunset at the end of 2010, and annually in December they just kept kicking the can. And so from a planning perspective, those years were difficult because we saw them do it a couple years in a row, and so then the discussions were, well, here's what's supposed to happen, but here's what they've been doing, so it's likely that that's going to happen, but we can't promise it. And so, to Katie's point, this is nice that until there is an administration change or some type of a shift where there's a in the government where they're talking about changing some of these things, we know what the playing field is.
Yeah, we'd see it coming rather than just a date on the calendar. You'd see the political climate heading that way.
Yeah, and while the estate tax, as Jordan mentioned, really in the grand scheme of things is not a huge revenue raiser for the federal government. I can't remember, it's like 1% or 2% of the budget. It affects a majority of our clients as far as dealing with estate tax implications, and it's also a good political talking point as well. But so let's turn it over to Katie. Katie, on the business provision side,
Yeah.
what stayed the same?
I'm going to pick up where Jordan mentioned the qualified business income deduction. That's a huge one that was set to sunset and didn't. Thankfully, for my pass-through entity owners, the qualified business income deduction is a 20% deduction available for certain business income that flows through onto an individual tax return. And the impact of that is huge because, in effect, if someone's in the top federal tax rate of 37%, and they qualify for a 20% deduction on their qualified business income, that effectively makes their tax rate 29.6%, which is a lot better than 37. So going from overnight effective 29.6% rate to what could be 37 would have made a huge difference, and not a taxpayer favorable difference. And I don't mean any political connotations when I say taxpayer favorable or unfavorable. It's really just, does it increase your tax or does it decrease your tax?
I mean, it was really a 10% cut because that top rate was set to go back up to 39.
True. Yeah. Yeah. So it was a huge thing to know that was staying in place with no significant changes. There's some tweaks to almost everything on the business side, but for now, we've got a permanent 20% qualified business income deduction.
Just to add to that, maybe one thing that was a little surprising is that the corporate tax rate did not change. We were expecting it to go up a little bit, so there's still a lot of disparity between the top maximum individual rate and then the C Corp tax rate of 21%.
Yeah, so 21% versus 29.6%, but C corporations have that double taxation.
They do. There's lots of planning around how to maximize those things, and maybe this is a good chance to talk about qualified small business stock, thinking about C Corps. So qualified small business stock has two components. There's an entity level component and an individual component, but originally issued C corporation stock held by individuals or others, so QSBS, qualified small business stock. If you hold it long enough and it was issued at the right time, it's subject to no tax effectively. The old rules, which have now been expanded, was a $10 million exclusion on gain if you held the stock for 5 years. They have loosened the regulations enough now that there is a shorter window. You can get a 50% exclusion if you hold it over 3 years and a 75% exclusion if you hold it over 4. If you hold it over 5, you can now get a $15 million exclusion. So the maximum exclusion has gone from 10 to 15. If you're familiar with this at all, the 10 times basis, which is an alternative calc, still exists. They also expanded the business side, so your business has to be eligible to issue the stock. The business has to have a gross asset value when issued of less than 50 million. That's the old rule. It's now been expanded to 75 million. So they haven't changed those rules since the enactment of this qualification. So my understanding while researching was this was meant to peg it to inflation over time. So they've raised the asset value to 75 and they've expanded the exclusion to 15 million. What's interesting about that is they're indexing it to inflation going forward. So the fixed 10 now is 15 that's going to go up each year hereafter. So really interesting.
That's a lot of numbers and stuff,
Yeah.
but I do want to point out that is premier tax planning, the qualified small business stock. If you can qualify for that, that is basically avoiding tax altogether rather than deferring it.
Yes,
So we
permanent
have
exclusion from income.
So we have a number of clients that have S Corps. Do they qualify?
S Corps do not qualify. But there's a lot of planning that you can do if you are a pass-through to start. There are things that you can do. It may affect your hold period, but you can get into that C Corp structure if you're planning for an exit. There are other gifting strategies and things like that where if you have a family group, you can get multiple exclusions with good planning. And so it's something that we do a lot. C Corps are near and dear to my heart, and so I spend a lot of time in that space working with them and their closely held owners. The people that we think are going to most be impacted by this is PE, because they have a really favorable
What's
Private
PE?
equity.
private equity. I apologize. So when I was reading a little bit about this to see who we think is going to benefit, there could be a flurry of private equity activity on smaller companies seeking out these exclusions. So if you think about back into it, then the companies they want to buy need to be C Corps. So there's proactive planning that we can talk about and do if you're in that thinking about an exit phase for your business. And if you've got a 5-year timeline, what can we do? 100% exclusion on 5 years of work. It's pretty fun for us when we get to do that and partner with our clients.
So it's C Corp, not S Corp. If you own C Corp stock and it's, meets that qualified small business threshold, does your stock automatically qualify?
By automatically, you mean, do you
All
just get
industries?
it?
Well, I think.
Oh, I think you're referring to the fact that there are ineligible businesses. So there's a business, the type of business is a requirement. That's a pretty long list of things, but typically consultants don't qualify, accountants don't qualify. I think the incentive is they really want you to build something, whether it's IP or real. So, but those are things that we would analyze and work with you and help you understand.
There was actually the other piece, which is how you got your stock.
Correct.
That there's very specific rules around that, and that it's not just owning stock doesn't get you this magical card.
It's a complex code section that requires careful planning and a lot of consideration. So I think the importance is that it's out there. And, I work a lot in this space, and so I do bring it up regularly. But if you're not familiar with it or a practitioner isn't familiar with it, it oftentimes gets overlooked.
Yeah, and it's definitely an area that Sean does a lot of work in, and it's something that requires a lot of diligence to ensure that you qualify given the size of
a lot
numbers.
of record keeping, certainly. A lot of careful thoughtfulness and documentation.
If you check all the boxes, it can be great, though. But I think this is a good point to mention state conformity as well, because there may be states that don't accept qualified small business stock.
Oregon and Washington do, which is great for the majority of our client base.
Yep.
So
I think there are a lot of things we'll talk about today that have state conformity as a consideration, and it's important to me because I have a broad base of clients that are all over the country, and it can be a factor in deciding which of these provisions are beneficial to you.
Yeah, definitely. Well, we haven't heard much from Trent yet. Trent?
Oh, I've been the peanut gallery. You've heard from me.
Well, why don't we talk about a topic that's near and dear to your heart, real estate? Have there been any provisions that impact our real estate focused clients?
Yeah. On the real estate side, one of the things, qualified business income deduction, so that being extended or made permanent is a massive thing. One thing that we haven't touched on yet is depreciation. So 100% bonus depreciation came back, almost back to the beginning of the year. We're back at the magical January 20th date. And I'm going to
Inauguration Day.
Oh, is that where that came from? I didn't realize that.
Mm-hmm.
I'm going to get into that because there is a planning piece or something that's important to know on that as it relates to real estate here in a moment. But we were under the TCJ, under the old rules, we've been kind of escalating down in terms of bonus depreciation or accelerated depreciation, and we were at 60% for 2024. We were set to be at 40% this year, 20% next year. So, just right off the bat, going back up to 100% is massive for real estate because we didn't get any changes to any definitions for property. So as part of TCJA, there was it took a little bit of fixing after that first year, but there's the concept of qualified improvement property. So for non-residential property, if you're making improvements to the interior of the building, that generally should qualify for 100% depreciation. So for our commercial landlords, our commercial property owners, that's a huge component. The concept of cost segregation, where you're breaking out your building into smaller components with 100% depreciation, the power of cost segregation is just multiplied significantly compared to 40 or 20% for 2025 and 2026. So that's a huge area that we're already focusing on. I think another general area that impacts more than just real estate that was part of the bill is the adjustment for our interest expense limitation. So as part of Tax Cuts and Jobs Act, there was a limitation that was introduced under a code section 163J. So it's okay to,
Interest expense limitation.
Interest expense limitation. And under that, we're limited to 30, in certain circumstances, we're limited to 30% deduction on an adjusted taxable income number. And that adjusted taxable income number changed in 2022 under the old law, where before we were taking an income number and we were adding back interest, depreciation, amortization expenses. 2022, the only thing we could really add back was interest expense, so it became a lot more limiting.
I'm going to use another acronym. So it very closely mirrors EBITDA now.
Yeah. It,
so
again,
a lot of
which
the
is,
financial
a lot of what's in OB3 is really what was in the original TCJA. From our perspective, the runway is great from a planning perspective, but I feel fortunate that we don't have dozens of new concepts thrown at us like we did with TCJA. It's kind of tweaking along the edges. There are a few things that we'll probably get into where there was a little bit more substantive changes, but for the interest limitation, that's really going back to the rules we had in place for 2018 through 2021.
I think one thing that you mentioned that sticks out to me is the interplay of those two things, the bonus depreciation and the interest expense limitation with that depreciation adjustment. So
yeah, because you get the 100% depreciation, but it doesn't mean that, because we're taking this extra depreciation, we're going to be limited on the interest side, because that just gets added right back. And so our interest expense that we're going to be able to take if we're subject to this limitation. And this limitation, not to get into the weeds there, but I mean, it's for small business taxpayers, don't have to worry about. This is more for larger taxpayers, quote unquote,
and
tax
some of
shelters.
Our real estate clients that aren't necessarily what you would think of as large taxpayers still are subject to this provision.
They fall into a little trap of a quote unquote tax shelter, even though it's not really what we think of a tax shelter. So we are monitoring that in our, that's part of the planning that we've done historically is, kind of looking at these agreements ahead of time to see, are there ways that we can, especially in real estate where leverage is key. It's, not often that we don't have unlevered property, and so we have interest expense. Are there ways that we can plan around being limited under this provision that was, brought in that never existed prior to 2018?
Right.
Yeah, it kicks in with real estate, small with lower gross receipts. If you've got like passive owners, right? More often,
right.
A situation like that, and
exactly.
losses. Losses allocated to passive owners, that's where it can become an issue. So bonus depreciation can be used to create losses, which is a beneficial thing in some cases, but if it subjects you to, if it makes your entity into a tax shelter, that's not necessarily a good thing.
Agreed.
Good thing we can elect out.
Exactly. And Katie, do you want to talk about the interplay of bonus depreciation along with the increase in the 179?
Yeah.
Oops,
179.
I don't know how you get around that.
I don't know
That
how you
one's
get
hard
around
to
that
get
one.
around.
Automatic
but that's-
expensing election.
Yes, very good. So there are two different options when you're trying to maximize depreciation under the tax code, two really good ones. The bonus depreciation that Trent talked about, where we're back to 100% immediate write-off, no limitations. You can create losses. It's not limited by how much you purchase during the year, where the other option is this expensing election under Section 179 of the tax code, but that election is subject to limitations. So the limitations increased under the OB3 to 2.5 million, and it phases out with purchases greater than 4 million during a year. But the differences between those two are pretty significant. So Section 179, you can't take you can't create a loss with it, basically. You can't go into the negative with 179. There's a limitation there, as well as the purchase limitation. So it is more limited in that way, but it's more flexible in the way that you can pick and choose which assets you want to take 179 on. You want to immediately expense under that code section. Here I am saying the code section over and over.
You can't help it.
I think something that's really neat about that planning, though, is that net operating losses are limited now when you use them, right? Section 179, there's no way around that one, guys. Section 179 has no 80% limitation. So if we're net neutral on our analysis on creating a loss or creating what's called a carry forward of 179, we can use all that carry forward instead of have a limitation on our loss when we utilize it. So it's pretty fun planning for us to be like, hey,
Yeah, it's a really, well, it really impacts on the C Corp side.
Yes.
Yeah.
Yeah.
Yeah, I think the other thing to keep in mind when choosing between bonus depreciation and Section 179 to expense assets immediately is state conformity. Again, states
Katie's got a theme.
Yeah, they don't all go along with this. Some will go along with bonus depreciation and not Section 179 expensing. Some are the opposite, and some have their totally own structures about, a $25,000 limit to Section 179. So it really is all over the place, state to state. So if you're a multi-state business, that can factor into how you make your decision on expensing assets as well. Well, where bonus, you can elect out of it on a class-by-class basis, but that means everything that is 5-year property, if you elect out, you can't take bonus depreciation on any of it.
Yeah, and actually, we have some questions from our live stream audience, and a few of them relate specifically to depreciation, and this touches on what you discussed. What asset classes specifically benefit from accelerated depreciation now, and how much can you depreciate?
I'll answer that, but I think all of you guys know this, but it's 20 years or less.
And so what do you mean by that?
As identified under modified accelerated depreciation, makers, if it has an asset life of 20 years or less, then it would qualify for bonus depreciation. There's a new special category. Is this the time to bring that up?
Well, I think, so 20 years or less basically covers everything but buildings, and even buildings can qualify in certain circumstances.
They can. So it's equipment, furniture, interior improvements that are qualified improvement property, sidewalks, parking lots, land improvements like that, machinery, that sort of thing. But the new and exciting category is qualified production property. So that is a real estate asset, non-residential real estate, that is built to for the purpose of manufacturing, refining, processing tangible personal property. And if it meets certain criteria, that now qualifies for 100% bonus depreciation, which is pretty significant. We've had some discussions about this internally about whether this will actually benefit any of our manufacturing clients. It may serve to entice some manufacturers to construct new factories and production facilities here in the U.S., which would be nice, just in general for the real estate sector. But a lot of our clients have structured their companies intentionally to have the real estate held in a separate entity from an operating business. And this class of property that qualifies for bonus depreciation is tricky because you can't use if you're a lessor of a building, you can't qualify for this because your lessee uses it for manufacturing. It's only if you yourself use the building for manufacturing, production, refining.
So I know we have some real estate investors that are in the audience. So just to make it clear, this isn't something where they can go out and build a manufacturing facility and lease it out and get that 100% bonus right off of the building.
Right.
Yeah.
Correct.
Yeah, this is really meant for the manufacturing distribution industries. It was, that was part of the campaign, and this is an example, I should say, of really kind of taking what is being talked about and putting it into legislation of, hey, we're trying to bring jobs back. What's a way to incentivize companies to do that?
Mm-hmm.
What's a way to, because that was a lot of the discussion is, hey, we want to do that, but that's not cheap and it's not quick, right? That's billions and billions of dollars of investment that are needed. So this is a way to help incentivize that. And I guess while we're talking about that, just a quick segue that all of us up here do not have any foreign or international tax expertise. So this discussion is not going to touch upon that. I see out of the corner of my eye, our partner Yulia. There were changes in OB3 on the foreign tax side of things. And so we at Perkins do have the resource. We have the resources, not on this stage, but at the firm to handle those questions. So if there are questions in that area, please reach out to us. Yulia would be happy to talk to you. I would not be happy to talk to you about those questions. I would love to make that introduction.
We'll just send you over to Yulia.
Trent, you touched on something that I think is important to point out on the qualified production property, how expensive that kind of thing is to incentivize in the tax code. And I think that's where we should probably circle back. And we were talking about a lot of things being made permanent. That's not one of them. So that one has an expiration date. Those expensive kind of campaign promises, if you will, are the ones that tend to be temporary in this new legislation, and that includes the qualified production property provision. I think that has to be placed in service by the end of 2030.
I think so, yeah.
So it's a short window for that to take advantage of that provision in particular.
Okay. Let's go through another set of questions from our audience. And this one is for Jordan. So somebody was asking if Jordan has insight on the estate exemption limits, specifically in Oregon, and do we forecast this limit will change? So can you talk about what that refers to and what your insights are?
Yeah. So, the federal exemption went up to this $15 million limit, which is wonderful and can help with a lot of our high net worth clients. Oregon, unfortunately, is, stuck in the past where that exemption is still $1 million. It's not indexed for inflation. There isn't anything that I know of on the horizon where that's going to change. We would love it if it would change because, I always tell clients today, if you live in the state of Oregon, you own your home, you have a 401k, you're probably subject to the Oregon estate tax.
Yeah.
So,
and oddly, Oregon conforms to federal tax law in almost every other way.
Right. Yeah. So it doesn't take much to have an estate tax problem in the state of Oregon. And so a lot of clients we work with actually, they may not be subject to the federal estate tax, but they are subject to the Oregon estate tax, and that highest rate is 16%. And so there's a lot of planning that can still be done that, conforms or would conform with federal planning, but it applies to the state of Oregon for estate tax purposes. So there is trade-off to always consider between estate tax savings and income tax savings. And so that can be kind of a careful analysis depending on the assets that someone has in their estate. But it's not something to ignore or be passive about.
Yeah, I think that's a good point of a lot of people can think $30 million is a lot, which it is, but so I don't really need to do it. But that's a lot. You can have a lot of Oregon estate tax while not paying a dime in federal, and so there's some real planning that Jordan and the legacy planning team can do to help you with that.
Mm-hmm.
Jordan, you might mention Washington's change this year.
Yeah, and so
can you repeat that for the audience?
Sure. Yeah. So Pacific Northwest, state of Oregon has their $1 million exemption. Our neighbor to the north, Washington, also has their own estate tax regime, and so that was just north of $2 million. But around the same time, let's say of OB3, Washington actually changed their estate tax and increased it to $3 million, which on the surface sounds great that exemption went up, but they also increased the tax rate. And so I believe that's now sitting at 35% as its highest rate.
Oh, wow.
And so, if you have somebody who has a large estate where they are federally taxable and then also taxable in Washington, you've got 40% to the IRS, you've got 35% to the state of Washington. And so, you've got a large combined estate tax there to consider and plan for.
That is interesting that it's that high of a rate because we have seen a number of clients that have decided to maybe move from Oregon to Washington to avoid individual income tax, but I think it highlights that there's a lot of factors to consider if you're thinking of making such a move. Do you want to expand
Absolutely.
on that?
And so, it's there's also other elements with the state of Washington to consider too. But absolutely, I think, then it becomes really planning on how you hold your assets, where are you domiciled. And so that residency planning is a big thing that our team does. And so just being really careful about where you're parking assets and even, living out your life. We don't want to sway clients from necessarily living where they want to live. So there's more to it than just taxes. But I think it's really having a thoughtful, proactive conversation so our clients can make an informed decision.
Exactly. All right, I have another question from the audience. Depreciation, it's a hot topic here. So, Katie, does Oregon and Washington allow for the full accelerated depreciation and 179, so bonus and 179?
Yes. So, as it stands, Oregon conforms to federal law and would allow the 100% bonus and 179.
Oregon did give us a little bit of a scare earlier this year, didn't they?
Indeed, yeah. So we have in Oregon what's called a rolling reconnect, basically. We're connected with the definition of federal taxable income. So anything that happens in federal taxable income goes for Oregon too. It's not like California where there's basically a whole separate tax code, a different way of calculating taxable income in that state. Oregon starts with federal taxable income and then makes adjustments to that. One of the big adjustments historically is the qualified business income deduction. Oregon doesn't allow that. That's specifically carved out of that rolling reconnect to federal changes. But it makes Oregon kind of nervous. The legislature gets nervous when there's federal tax changes that are significant because of the impact that has as it flows through to Oregon taxpayers and the amount of income that comes into the state. So there was a bill this most recent legislative session introduced that would have paused the connection because there was uncertainty while the legislature was in session what would happen at the federal level. That ended up, I think, in committee and didn't pass during the session, but there's a lot of attention being paid to these federal changes because it's pretty costly for Oregon to go along with some of these, like accelerated depreciation, for example. So I wouldn't be too surprised if we see that come back again. So again, when it comes to state conformity, not only look at what the law is now, but keep an eye on what's happening in all the legislatures.
Might be worth noting that also here in Portland, Multnomah County, and Metro, they also conform to Oregon, which conforms to the federal. So bonus depreciation is also available in those jurisdictions.
If that is on the chopping block, something else that I would anticipate also being on the chopping block with much more limited use, but that was in the OB3 was an extension of the Qualified Opportunity Zone program.
Yeah, you want to touch on?
Touch?
Yeah.
How much time do you want me to fill? I can fill a lot of time. Should we save this till the end for any buffer time? No. Qualified Opportunity Zone program, near and dear to my heart. I spent a lot of time digging into these details because it's a very specific program with some very powerful tax benefits generally related to real estate. It's got scope beyond that, but in practice, really, real estate is where we've seen, at least here locally, the major investment. And that was another program set to sunset. And with the OB3, they did kind of a modified permanent extension. They extended it, and what they did is they're going to redesignate zones every 10 years. And so for the Qualified Opportunity Zone program, high level, so this is where you're investing capital gains into a fund that's investing in certain designated geographic regions in the country. Instituted as part of TCJA, even though it was actually a concept that had been floating around in DC prior to that, and they just kind of folded it in. And it had terrible timing because it's like I said, pretty complex. Took a long time for the IRS to roll out guidance, and so a lot of real estate developers were really sitting on the sidelines in 2018 and 2019 while we were waiting to see what are the rules on these things. Because we got some proposed regulations in late 2018, early 2019. We didn't get final regs until December of 2019. So we didn't really know what our true landscape was until December 2019. So how much time did we have before the world shut down for a while? And so the impact of COVID on the Qualified Opportunity Zone program, I think, was really, really significant. And it did not do, I think, what it was intended to do. And so the extension of this program, and I think they took to heart some of the criticisms of it. So they're going to be redesignating. They're going to be looking at the population data slightly differently than they did the first time. One of the other aspects is it's a self-reported program. So that was some criticism. Are these funds really doing what they're saying they're doing? There's going to be increased reporting around the new program that goes into effect 1/1/27. So we still have the old program through the end of 26, but we have the new one. So you can defer capital gains. You hold your investment for more than 10 years. Gains after that 10-year hold period are not subject to federal taxation and currently not subject to Oregon taxation. So because of the rolling connect. Now there had been murmurs that they were going to disconnect on that in earlier years. So that's something that I could see on the chopping block again, especially now that it is essentially made permanent. But, I think that this is going to be a really good thing for real estate developers going forward is, now we don't have this very defined hard cliff. Really we saw a real slowdown. We saw a rush of activity kind of the last 2 quarters of 2021 when one of the benefits was set to expire at the end of 21. We've seen some work in that since then, but I expect to see a steadier stream of projects and developers being able to take advantage of the program.
So that's not just for real estate developers benefit either. It's basically anybody that has a capital gain could invest in one of these.
And really that was the intent of the program. The intent of the program was, hey, let's bring capital out of the markets and into certain geographic regions that the local jurisdictions are deeming need some TLC. They need some investment in those areas. Let's bring people that wouldn't normally do that. One of the main people behind this was Sean Parker, one of the early Facebook guys that was, sitting on 8 or 9 figures of unrealized gains and, kind of thinking, hey, how can I put this capital to better use? And so that is the idea is that, people working with Jordan in the legacy planning where they're not real estate folks, but they can make some investments that would have some great long-term tax benefits.
Great. So let's segue or move into a different area. Sean, I'd love for you to talk about the changes related to research and development expenses. I know I have a number of clients that were significantly impacted by this, as have you, and Katie's nodding her head. And so we're waiting to hear what's the latest.
Yeah, I'm so pleased because the hardest conversations I've had in my career have been around research and development, research and experimentation, and the changes that happen as a result of the Tax Cuts and Jobs Act. So the Tax Cuts and Jobs Act changed the historical deductibility. You used to be able to deduct 100% of your research and development costs currently as they're paid for, regardless of who you're paying and where you're paying for them. The Tax Cuts and Jobs Act said, no, starting in 2022, so it's been that way since 22 now, you have to capitalize them. And you get to recover those costs, but it depends on who you paid. So if you paid for research to be performed in a foreign jurisdiction, think foreign contractors, foreign developers, we're gonna make you recover that over 15 years. Domestically, 5 years. And that's just effectively straight line over that period. So they gave us back domestic research, so we can immediately deduct domestic research. We still have to capitalize foreign incurred research costs. So that the economics of that is we're trying to pull development back in, trying to make it more attractive to do development in the U.S. The research credit is still available to the domestic research costs. So what are we going to do to get it back? Well, they said, okay, if you're a small business, and small business for our purposes is average annual gross receipts of less than 31 million, that goes up each year for inflation. you can go back and make it retroactive. You can go back and amend 22, 23, start deducting those costs in 2024. If you're a large taxpayer, we're going to give you two options. You can start in 25 and recover in 1 year, or you can split it over 2 years. What's interesting about that, as I started modeling this in my head, I'm like, well, why wouldn't all my small clients just go back? Well, there's a lot of complexity to the compliance around that. And so you've got partnerships with 20, 30 partners. Those all require amended returns. That's one thing. Maybe you had ownership changes and you're pushing deductions around, and maybe you have different goals now. Maybe you want them in the next year. There's also an interplay between the interest limitation too. So really it's a really thoughtful analysis that we need to go through and work with our clients to decide what's going to be the best way to recover these deductions. But the conversations are easier now because we get to continue to deduct this stuff. We do have to continue analyzing, though, whether or not the costs were incurred domestically or foreign. So it's not quite as easy as it used to be prior to 2022, but it's back.
There's some software quirks in there too.
There's certainly some software quirks.
Yeah.
As it with any tax law, there's always quirks. But no, this the deduction of research and development costs was something that we've all been waiting on for, ever since it was first enacted. It was just such a huge negative impact to our clients and many
Just
small
the
taxpayers.
cash flow impact was so significant. I work with a lot of startups, and they're all bootstrapped, and so you're putting in all your own capital. And what are you doing? You're developing something, software, a product, but you don't have any money because you're spending all of it. Goes out, but now you have to capitalize it. And in those first couple years, because the recovery hadn't caught back up that fast, you're paying potentially 30% Fed and state, or 21% in a C Corp on this phantom income, if you will, because it deferred the deductions. Those were really hard times for a lot of our client base. And, it were difficult discussions to have. We've been waiting for this fix for a long time. We wanted it all back, as a community, all research and experimentation. We got half of it, but, I think it seems like a fair compromise in the sense that we want to drag development back to the U.S.
Mm-hmm. Definitely.
I was shocked that they offered the
Oh, me too.
The retroactive application for small businesses. I just thought that it would be a catch up, and so that's a major,
Well,
we have to think about, like you said, we have to think about when it's going to.
Well, and worth noting, we don't know procedurally how to do this yet. The IRS hasn't provided any guidance on how to do this.
Yeah, I think that is worth noting because I had some of my clients reach out to me that weekend after the bill was passed. Okay, when are we going to get my money back? It's like, well, I definitely want to do that for you, but we need to wait to hear how the IRS wants us to go about this.
Well, and it's really a bigger question for those small businesses, which small businesses are large businesses. Like 30 million is a lot, but but it's really there was ambiguity on if it's all or nothing. If you want to start deducting those costs in 24, must I go back to 22 and 23 and fix it, or can I make the change in 23 and 24? Because there's plenty of planning and advantage. There's better years to do this. And so our current belief is that it is all or nothing. If you haven't finished your compliance for 24, if you choose to take the deductions this year, you will have to go back to 22 and 23. And currently, we only have a year to do that. So I'm going to try the date July 6th of 26.
July 4th.
Yeah, it's enactment date. I think you've mentioned a lot of things that we can tie a lot of these things together in a way that's important. Is that you've got to, it sounds great to go back and get that expense, like intuitive, that's what you want to do. But the interplay of all these other things we've talked about, like the excess business loss limitation and various limitations on deductibility of expenses, basis limitations, at-risk limitations, passive activity loss limitations, all of that stuff plays into whether it's beneficial to amend or not. So it's not something that most of us can just do intuitively. It really,
we have to model it.
Yeah, a lot of what we've talked about, the way all of these provisions interplay, and how some are temporary and some are permanent, and phase in and phase out, and limitations that come into play. It really is not an easy thing to do unless someone has extremely simple fact pattern, and our clients don't. I mean, life's messy, business is messy. There's a lot of complications that come in. So it takes modeling.
And even if you think it's simple, you'd be surprised when you run it through the modeling, you may end up with a different answer because there is so much interplay.
You don't consider the one little thing.
Exactly. Yeah. So let's, anything else on the research and development front, or did that?
No, I think that, I don't know how many people work in the technology space in the audience, both here or virtual, but I spend a lot of time in that space. And so it's been, it's going to be a fun year planning on what's going to maximize that recovery benefit for our clients and doing the best we can in that space.
Yeah. So any questions, feel free to, ask them or continue submitting them online. So, Trent, did you have something?
Well, I had a question for Jordan. But
Okay. Well, I was going to actually ask Jordan, do you want to talk about some of the changes that, some of the things that did change as a result of OB3? Because we haven't dove into some of those individual provisions.
Yeah, absolutely. I think a couple of the noteworthy things that will impact our clients. One is with itemized deductions. So now it's not quite the P's limitation we had before, but it's similar where now clients who are at that highest.
What's P's?
I actually don't know what P's means, Katie.
Sorry,
Can you
I
let
didn't
us
mean to
know?
put you that much on the spot.
Can I phone a friend, the police?
It's a name. It's a
name.
name that was applied to this limitation based on, I don't know if it's the person who came up with it or what, but.
Yeah, and so, but ultimately what it does is for our clients who are at that 37% tax rate, it limits their itemized deductions effectively to 35%. So that 2% may not seem like it's a huge difference, but if we have clients who are very philanthropic, who are doing large charitable planning, that can be quite a haircut on that benefit. And then further with that, with charitable planning, there's now actually a floor that individuals have to get over in donating to actually get a benefit for their charitable deductions. It's only 0.5%, so it's not, large like our medical deduction floor, but it's still something to consider when clients look at how high is my standard deduction, and also how much charity or charitable donations do I need to make, whether or not I have the state and local tax exemption of $40,000 or not. So, following the thought of all this takes planning and there's interplay, there's a lot more going on, I think, in that itemized deduction individual tax world, where we can't just simply say, if you do this, this happens.
And I think the charitable change to that is not effective until 2026, correct?
That's my understanding, yep.
Yeah.
So, and then, and so that I think brings a huge opportunity where now in 2025, for clients who are wanting to do charitable planning and not be restricted with these items, this is the year to do it. And so I think a lot of foundations and charities are crossing their fingers and hoping to see that larger numbers will come out. So to be determined, but yeah.
Yeah, the numbers can get significant. I was chatting with one of my high net worth individuals, and based on what their current, adjusted gross income is, they had to donate in excess of $35,000 before they saw any benefit from their charitable contributions. So it does work out to be a significant number depending on an individual's income level.
Yeah. And then, the other thing that I think was portrayed a lot in the media was the state and local tax deduction. That came up and was talked about in a number of ways. And ultimately where they landed is they increased that limit from $10,000 to $40,000. That is one of those provisions that's not permanent. So I believe it only goes until 2029. But it also only qualifies for individuals within a certain income bracket, or I guess income range. So once your AGI gets above $500,000 for a married couple, that $40,000 limit starts to go away. Once they hit $600,000 of income, then they're back down to that $10,000 limit. So on the surface, everyone thought, hey, we're, in the state of Oregon, high income taxes, we're getting this saving, we're getting this added benefit, but I think not so fast. There could be some interplay there, but it opens up the opportunity what can we do to shift income, to accelerate, defer, or when do we make that large charitable deduction? When can I bring someone's income down to maximize that other benefit?
Well, that was going to be my question. Is I do mostly pass-through entities. The pass-through entity taxes that most states have introduced in the past 4-5 years are a pain. They're all different. Almost none of them make sense the way that they set them up. But what you're telling me is we're going to still want to do those because that's where there's going to be benefit. That, you know, we're not going to want to stop doing those pass-through entity taxes when those are available for S corps and partnerships, because it's very likely that that state local tax is going to be limited at the individual levels.
Or we're making our own lives really hard because
Yeah.
you got to look at it each year and forecast accurately early too. Because like California, for example, requires you to make this election by mid-year. And if you want to, like, you can opt out after the fact, but you've got to be paying in and doing those things all along. So it's
they're
going to be an
talking
interesting
about
period of time.
They're talking about the workaround for that $10,000 or $40,000 limit, and it can be very beneficial despite it being a pain. It can be very beneficial to deduct state taxes in an entity, rather like a pass-through entity, rather than on an individual tax return, because pass-through entities don't have a limitation in the state taxes they can deduct in the same way that individuals do. So deducting it in the entity can be very beneficial. That was something that was on the chopping block for a little while, but it ended up staying. It's okay to do these workaround pass-through entity tax programs that the various states have put into place. It's okay from the federal perspective. Whether the programs will continue or be modified at the state level is something to keep an eye on too, because Oregon's is set to expire after 2025 currently. I think they could extend that. And probably will.
They get their money faster. I don't
Yeah.
see them not extending it personally.
But every state's different, so something to keep an eye on as you're planning.
They are all different, and none of them really make a lot of sense. It
As you
shouldn't
can
be
see,
this hard.
Trent's a fan of these.
I'm a fan of the benefit.
Yeah, definitely.
I was not a fan of the execution
Yeah,
by any of the states.
yeah. So Jordan, what about tips? There's been a lot of, there were a lot of talk about exclusion of tips. Does that mean that our clients can now tip us rather than pay us, and we don't have to recognize that as income?
Yes, of course they can tip us, Brigitte.
I
Of
would
course.
love that.
Cash
That-
preferred.
Yeah, absolutely. There's a bucket at the door. No, but it's the tips credit or the exclusion for tips. It applies to a select subset of individuals who are really, in the ordinary course of their business, getting tips. So think of your bars, salons, anyone who you would really tip, your barista. They're the ones that can ultimately exclude that. There is a limit. I believe it's $25,000 of income that they can exclude in tip income. And there's going to be, I think, some reporting issues there, for companies to have to track that if they're the ones who are operating that entity, bifurcating what that income or that tip income is. And there's also this definition of qualified tip income. So not all tip income is actually eligible. So it's going to be a bit of a headache. We're probably going to see changes on the W-2 form for that. But those are things where we're waiting for guidance and clarity.
Well, didn't the IRS initially say that they weren't going to update the forms, or for 2025? Yeah.
Yeah. So.
And it's effective in 2025, isn't it? Yes. Yeah, overtime. How
Yeah.
about that?
So, and then, the overtime, there's a different threshold. And so it's, I believe, only 12,500 of overtime.
And that's a deduction, right?
Yes. Yeah. But again, it's there's other nuances to it, and so and there's a phase out, I believe, with folks who at certain levels of income they're not eligible for that. So it takes careful planning. It will hopefully help clients that are in that medium income level, but it's going to be challenging. So it's a headache for a small deduction.
So on the tips side, I suspect this is actually a revenue raiser for the government. Like
To
even
get people
though
to
it's
report.
a
Tell me more.
yeah, just because of tips are notoriously underreported, right? So by allowing this deduction, it's encouraging people to report. But guess what? It's temporary. So they get you, and maybe it's going to raise Social Security tax revenue as well because it's still subject to employment taxes.
That's exactly what I was just going to say, is that exclusion is really just that federal exclusion, and I believe Oregon's going to follow, but it's still subject to, FICA. So
Speaking of Social Security, another buzz phrase out there was that now Social Security income is not taxable. What's the
False.
Thank you.
yeah, go for it.
There's a $6,000, is it an exclusion or a deduction? Okay, $6,000 for elderly taxpayers, we'll say.
I think anybody
65 and
or
above.
older.
There may be phase-ins, phase-outs, I don't know. But so there's Social Security is still taxable in the same way that it has been previously, up to 85%. And now there's this exclusion that some people qualify for $6,000.
Yeah. So it may be beneficial to some individuals, but a lot of these provisions related to the tips or the overtime or this exclusion for older individuals may not necessarily impact our clients directly, but it could impact, family members and such. So that's why we wanted to cover those.
And from an employer perspective, definitely. I think payroll's hard enough as it is. I mean, this might be another reason to outsource payroll if you're still doing it in-house. I do think there will eventually be changes to the forms. I don't know how else they'd be able to track the tip income and the overtime income for those deductions. Other changes coming to forms and reporting requirements for employers include 1099 threshold. This was actually a favorable change for a lot of business owners. Historically, you've had to issue 1099s to anybody you paid more than $600 during the year. That's still the case until 2026, where it goes up now to $2,000. So fewer 1099s. That's just one less reporting burden on employers. But things are changing.
So Trent, on the real estate front, I know a number of our real estate development clients may take advantage of 45L or 179D. Excuse the code section, but you want to talk about that and what changes may have taken place with those programs?
Yeah, as part of OB3, kind of one of the bigger areas that was impacted was from the Inflation Reduction Act of 2022 around energy efficiency. So the Inflation Reduction Act instituted a number of tax credits or programs to incentivize various forms of clean energy. OB3 pretty close to wipe those out. There was significant changes on the electric vehicle credit. There was already incoming thresholds there, so our clients generally didn't qualify there, but those were wiped out. On the real estate side of things, a couple of things were the Section 45L credit, that's the home builders credit. So for home builders that sell houses that meet certain energy efficiency, before the Inflation Reduction Act, it was a $2,000 credit that got bumped up to either $2,500 or $5,000 depending on the level of efficiency in the house. That also extended to multifamily properties. So if you were building apartments, you could potentially qualify more projects there. So this is going away as of June 30th, 2026. So we have a little less than a year to take advantage of that. On the energy efficiency side, Section 179 for energy efficiency property and buildings, there's kind of two components to it. On the building owner side, there was a deduction where we could carve out certain improvement costs or certain energy efficiency costs. We didn't see that as much on the landlord or on the building owner side of things because cost segregation generally got us most of there's more benefit to cost segregation where the benefit of paying for a study there didn't pencil out as much. Where we really saw it was on the architect, engineer, construction side, where the Inflation Reduction Act extended that those deductions could be passed out to the designers. Prior to the Inflation Reduction Act, it was only for governmental projects. That got extended to nonprofits as well in 2022. Those are all going away as for any projects where construction hasn't started as of June 30th of 2026. So we've got a very quickly ticking clock on getting the benefit of both of those. The other one on the real estate side, on the clean energy solar. So the solar credit, if you're putting solar panels on your property, that is going, you have to have construction underway by the end of the year in order to get your 30% credit. The benefit of that is reduced already, though, because that used to be a 5-year asset that was eligible for 100% bonus. That 5-year treatment was taken away. So if you did get your project in where you're qualifying for the credit, your depreciation's over 39 years. So it used to be a really nice double benefit of bonus depreciation and the credit. That's been limited, and obviously the runway is very short now on that.
We were talking about 179 automatic expensing elections earlier. Are you telling me there's another 179?
179D.
Capital D, right?
Only for a little bit longer, though.
Right. It's basically anything that had the word clean or efficient, I think, in the name of the provision, gone.
Yeah. One other thing I wanted to ask Jordan about, can you touch on the Trump accounts?
Yeah.
Because I do think this is an interesting thing and really beneficial to those with young children or children.
Yeah, so I unfortunately missed it by 1 year. But so now for kids born, I believe from 2025 to 28 right now, the government's going to fund a savings account with $1,000. There's still some legwork that the family of the individuals need to do to open the bank account and get everything registered. But that account ultimately grows and it's accessible once they're 18. And so, you know, it's a great incentive, but it kind of adds to the mix of what we already have of different deferred type savings accounts like a 529. But it's a great opportunity that's there.
And can't parents or grandparents or whoever also put additional money in? I can't recall what
so it's
limit-
$5,000 a
$5,000
year that can be contributed to that account.
which is significant.
Yeah, absolutely.
So if current children do not qualify, is that correct?
Yeah, so my understanding is that, yeah, my daughter who was born in 2024 is not eligible, unfortunately.
Mm.
So we'll have to try for a second one in that
There
year.
you go.
So, yeah.
Just for that credit, that $1,000 will be well worth it.
I've got 2 kids. The math does not work that way.
No, it doesn't, yeah.
All right. Well, let's just see, and I apologize for the noise back there.
That's my apology. That's my computer. Sorry.
Yeah. So, are there any planning opportunities that we haven't covered yet that we want to get into? You know, we've talked about, in general, you want to decrease tax. What are the ways of going about that? Deferring income, or maybe you want certain levels of income. Like, there's so many ways of interplay here.
Mm-hmm.
But Katie, you want to kick it off?
Yeah, I thought of something that we hadn't mentioned yet, and that is in relation to the charitable donations situation. Qualified charitable deductions. Do you want to talk about that? I mean, they've always been a good tax planning tool, but if you're not already taking advantage of that, that's one way to avoid the haircut and the AGI limits for charitable deductions it depends on the... Yeah, from retirement accounts. So if you're subject to RMDs, required minimum distributions, then you can direct your withdrawals distributions directly to a charity, correct?
Yeah. So there is a limit, so it's $100,000. But the nice thing is that if we do this qualified charitable distribution, or a QCD, so it's direct from your IRA custodian to that charity, that income doesn't even hit your tax return. So you're not getting a deduction on your itemized deductions, but that, again, that taxable income doesn't hit your return. So then when we look at the interplay of other items, your state and local tax, or the phase out that will kick in 26 on itemized deductions, that would be a way to bypass this.
But it fulfills your RMD, required minimum distribution
Right,
requirement.
exactly.
That's the big benefit, right?
Yep, absolutely.
I had a question and it escaped me. On the charitable front, if you don't itemize deductions, isn't there now an above the line deduction?
There is. It's relatively small, so that married filing joint couple, it's only $2,000. And there are certain deductions, like deductions to a donor advised fund, that are not eligible for that. So it's important to be thoughtful with that. But it's a great way for individuals who otherwise aren't itemizing their deductions. Maybe they're not gifting significant amounts every single year, but they're doing a few $100s here and there. It's a great way for them to continue to get a benefit.
Do you have any more questions, Susan?
So another thing we didn't talk about with the qualified business income deduction is the changes to the qualifications, I guess. So that's the 20% deduction after off of business income passing through onto an individual tax return. There has been a limitation in place for higher income taxpayers who own or operate a business, or own a business that operates as a specified service trade or business. That threshold where that limitation kicks in has been increased so that more owners of those businesses will qualify for the 20% deduction going forward. And those specified service trader businesses are basically accountants and lawyers. I don't know, doctors, yes, people who use their knowledge as their business. And the logic behind that is that we do all the work ourselves and don't hire enough people. But
Really?
supposedly,
Yeah.
No tips, no deductions. What?
yeah.
I really
We-
need to
we
rethink
need a
my-
better
they
lobbying
didn't say
on-
anything about
CPA
that
is
in
not
my.
getting it done.
The architects and engineers got some good lobbyists on that deduction. They're somehow excluded for that and only that from service trades or businesses. So,
I think we have a question now.
I know the accelerated depreciation over the last couple of years, there's been a step down. So is it permanent now, or is it going to sunset again?
it's permanent at 100% starting inauguration day of this year. So January 20th forward, anything placed in service from that point is by default, if it's a qualifying asset.
There is a little carve out that if it's a very small carve out if you had a binding contract, or if you had self-constructed asset that where significant construction had happened before that date, you're still under the 40%. But by and large, everything after that January 20th date is going to be 100%, no phase out.
So
And
40%.
in the cost seg report, this could include the 100%. If you go through with your cost seg, whether it's a new apartment complex or what have you, and you're
Correct.
doing this every year and you cost seg it.
Well, with cost seg, you do it once. Now,
You'll do it.
the great thing about cost seg is you don't have to do it on day one.
Right.
You can do it in year 3, 4, 5. You can do it in the future, and it goes back to day one, and you get a catch up.
But it's
And it would
based
be-
on placed in service
It'd be
date.
based upon place in service. So if you bought an apartment complex on July 1st of this year, and you do a cost seg, you're going to get that 100% bonus depreciation on the qualifying assets.
But if you bought it January 15th,
But if you bought it January 15th, or if you
constructed in
if you
place
were
in
midway
service.
through construction and you got your certificate of occupancy on July 1st, then unfortunately we'd be under the 40% for that one if we were mid construction. So there is some nuance there as it relates to it's not automatically that place in service date.
And the tax code gives us a lot of options, which is why we keep saying model, model, model. But one of the options that exists just for 2025 is to elect to continue the 40% all the way through the year. If that works to your favor for whatever reason, instead of taking the default 100% from January 20th through the end of the year, you can continue 40% instead. And that would come into play if you're subject to loss limitations and things like that. It might make sense.
Yeah, definitely. Any other questions from the audience? All right. Well, I think in general, the same tax planning strategies that we've employed in the past still apply. Basically, we're trying to decrease income, defer tax, exclude income. But as everybody up here has mentioned, it's really crucial to do the planning and modeling and not make assumptions, because you can get weird results. But if we don't have any other questions, I think we're going to wrap it up today. Thank you to my panel, and really appreciate all of our clients that came here in person, as well as those of you that are out there via the live stream. Have a great rest of your day.